Hi bankers, welcome to another episode of IIBS Institute of Banking Studies. This episode we are going to explain about the facilities for an exporter. This is the A module of the BFM paper and let us go to the topic. Export and import, the general guideline. See, when I say international trade, there are two different types of trade. One is export, another is import. So first, we will discuss about the export trade. What are the precautions or the guidelines which as a banker has to look into, and what are the various types of facilities, credit facilities and other facilities which are extended to the exporters. Those things we are going to discuss now. So in export also, we can classify it into 2-3 categories: export of goods, export of service, and export of software. So in export, actually what happens, the goods or service or software is going from India to a foreign country. So the goods goes out. And in turn, the price of the goods or the cost of that service or the cost of the software we are getting in the form of foreign exchange. So goods goes out, funds comes in, or we get foreign exchange and the goods is going out of the country. So there are two things happen. One, the movement of goods, another, the movement of fund. So here, look, there are two agencies which regulate the funds and the goods movement. The first authority is the movement of goods and services and software. So first of all, the movement of goods is directed by or regulated by DGFT. DGFT stands for Directorate General in Foreign Trade. This is functioning under the Ministry of Commerce and Industries in central government. So they are regulating the movement of goods, services and software. And there are other two agencies also. See, in the case of services, SEPC, that is Services Export Promotion Council. This is functioning under Ministry of Commerce and Industries. So they are specifically looking into the movement of services. And then with respect to the software, movement of software, that means export of software, there is an agency that is STPI that is functioning under Ministry of Electronics and IT. So these are the three departments which regulate the movement of goods, service and software. Now, they have a document. How they regulate the movement of goods or service or software? There is a document, and that document is called the Foreign Trade Policy. So the Foreign Trade Policy is, normally it is announced for a 5-year period. But for the time being, it was up to 2020, it was for 5-year period. But what happened in 2020 when the new policy was about to frame? The pandemic COVID has affected the entire world. Therefore, the FTP supposed to start from 1st of April 2020 has been cancelled or stopped, or the earlier policy they allowed to continue for another 2 years. That means up to 31/3/2023. The same policy was allowed to continue. And from 1st April 2023, they announced the new policy. And from that day onwards, every year they are announcing it. It's not a 5-year one. So every year, so the current policy is effective from 1st April 2025 onwards. So it is almost the continuation of the policy announced in 2023 with the small amendments they make. Therefore, remember the DGFT or the STPC, SEPC or STPI, these agencies, the governmental agencies, they regulate the movement of goods and services and software based on the policy announced by central government in the form of FTP, Foreign Trade Policy, or you can say it is the EXIM policy. EXIM policy stands for Export Import Policy. Now coming to the movement of fund, the regulation of the fund movement, what are the permitted funds which can be taken into India. And similarly for import also, it is regulated by Reserve Bank of India. So Reserve Bank of India is the regulator for movement of fund, and DGFT, SEPC and STPI are the agencies, government agencies which regulate the movement of goods and services. So how Reserve Bank of India regulate the movement of fund? They have the document that is the FEMA 1999, Foreign Exchange Management Act 1999. This act very clearly specifies what are the products or what are the items which can be exported, which can be imported, what are the fund which can be taken to India, what can be taken out. So it is very clearly explained in this FEMA guideline, and based on the FEMA guideline, Reserve Bank of India is regulating the movement of fund. And Reserve Bank of India also issue licenses to the authorized persons or authorized dealer, say AD category or AP category. Say AD stands for authorized dealer, AP for authorized person. So they have categorized 3 different types: category 1, category 2 and category 3. And these 3 licenses, these 3 different types of license has been issued by Reserve Bank of India to the institutions and banks which are engaged in international transaction or forex transaction. We have seen that category 1 all banks, category 2 some money changes, they can only engage in transaction except trade related transaction, means export import. Category 2 license holders, they are not allowed to do the transaction. Category 3, the specialized institutions which are incidental to export, that is SIDB and Exim Bank. They are holding category 3 licenses. So these things we have seen. Now, next is what are the guidelines for controlling the trade and exchange. The first one, any person or any entity, any institution, if they wanted to engage in international trade, they should first obtain a code number. And this code number is issued by DGFT. That code number is IEC code number, Importer Exporter Code Number. It's an alphanumeric 10-digit number. Therefore, any agency or any entity, if they would like to do a transaction in international trade, means either export or import, first and prima facie or mandatory requirement is they have to obtain the code number from DGFT. So there is an application through their banker, authorized banker, and they can apply to DGFT, and DGFT will allot a code number, and that is called the IEC code number. This is mandatory requirement. After the introduction of GST, the PAN is same as the IEC number. So the PAN number will be given as the IEC number, but they have to apply to DGFT and obtain that number endorsement. Next is in the case of export of services. Therefore, this IEC number is required for all. Any person, any entity engaged in export business. Now, next is even for import also this IEC is required. Now, export of service, apart from this IEC number, they should obtain registration from or registration from membership certificate from SEPC, the Services Export Promotion Council, or Federation of Indian Exporters Organization. They should get the registration. For software, they should get the registration from Software Technology Park of India. And import export should quote this IEC number and the registration number for all their correspondence. And next is the declaration form, export declaration form. These are the mandatory requirement. So registration, the IEC number. Now, if a person is engaged in export of goods or services or software, they should declare it in a specific format. That format is called the export declaration form. So in this declaration form, what the exporter is declaring? Export is declaring, I am exporting so and so to this country. So I undertake to bring in the foreign exchange, the value of the export in the form of foreign exchange. And here they will undertake 2 things. Number 1, the remittance, the money, the fund will come to India within a prescribed time. So within the time limit. Number 2, through an approved manner. These are the 2 declarations they are giving. So within the permitted time, the money will come to India, the foreign exchange will come to India, and the coming will be through a proper channel. That means through a bank. Approved channel, the money will come. So this is the declaration they are giving. Now coming to, again, the guideline, what is, I told you the declaration form. Declaration form for goods, there is one form, and for software, there is another form. So goods and services, it is EDF, export declaration form, and for export of software, it is SOFTEX form. So export of SOFTEX, the declaration form is export of software, the declaration form is SOFTEX, and other than software export, the form used is EDF, export declaration form. So now all the customs office are computerized. Therefore, this declaration form is a computer generated format, system generated format. Therefore, when an exporter make a shipment, at the time they have to take the printout, this declaration form, it's a pre-printed format, all the details has to be fed in, and the system will generate the format, and it will be generated in duplicate, and both the duplicate has to be signed and handed over to the customs authority at the time of shipment, and when customs authority approve this shipment, they endorse, they sign and hand over the exchange control copy of the declaration form to the exporter. So this declaration form has to be prepared in duplicate and has to be signed by the exporter, and it has to be handed over to the customs authority. When customs officials, when they approve the shipment, they keep one copy with them, and the exchange control copy, mark the exchange control copy, that copy will be handed over to the exporter. And the exporter has to submit this declaration form along with other forms to the bank at the time of negotiation of the export bill. We have seen what are the documents for an export. One is the invoice, next is the bill of exchange or draft, then the bill of lading, the transport document, then the insurance policy, then packing list, certificate of origin, wait list, all those things. And along with that, this declaration form also has to be handed over to the bank at the time of negotiation. And this declaration form, the bank will keep in their file. The rest of the document will be forwarded to the buyer to the correspondent bank. Now, this declaration form has to be submitted to the customs authority at the time of approval of the shipment in all cases except the following. What are the cases? Because there can be a question. A declaration form is not required for the following item. They will say 2-3 items. Now, what are the items where the declaration form is exempted? Number 1, trade samples and publicity materials sent free of cost. Because a manufacturer, when they produce a product, it has to be marketed. So people should aware, this is a particular product, these are the benefits. So they have to market it, they have to make a publicity. For that, they have to send some publicity material or trade sample. So that is not for payment, it's a free of cost. So this shipment of this publicity material or trade sample declaration form is not required because it is not for sale. Next is the personal effect. A person is migrating to a foreign country, or a person has got employment in a foreign country. So he is going there. He is shifting his residence. So in that case, he will be carrying personal things. So this personal belongings, it's not for sale. So no declaration form, no Forex will come to India. So for that, it is not required. So personal belongings, whether accompanied or unaccompanied, it's not required. Declaration form not required. Then gift worth up to 5 lakh Indian rupee, it is not required. Then trade fair and exhibition purpose, if you are exporting, it's not required. Aircraft and aircraft engine and spares for repairing and overhauling, not required. Goods imported free of cost on re-export basis, not required. On this is not required. Testing. Defective goods sent outside India for repair and re-import, not required. Status holders, special economic zone units, can avail EDF waiver up to 2% of the average export realization during the preceding 3 licensing years. That percentage is very important. This 2% of the average turnover for the 3 licensing years, preceding 3 licensing years, they need not declare. This facility is extended to whom? To status holders, to special economic zone. So the units located in special economic zone, that means there are certain areas earmarked by central government that is marked as special economic zone. They give a lot of incentives and concessions for promoting business or export. So that the units located in that special economic zone, they get 2% exemption. The average turnover is 2%. If 100 crore is the average turnover, 2% of 100 crore, 2 crore, up to 2 crore export, they need not declare. And then status holders. Status holders is high, well-rated export houses. They have been given status. They will give a star rating for 1 star, 2 star, like that. Status holders are there. Just like we rate the hotels, 5 star, 7 star, like that. So the export houses, which are doing very good business without any issue, and they have been allotted the status holder. So these status holders are also permitted to waive up to 2% of their average turnover. Now coming to gems and jewelry and precious stone business people, 1 crore or 2% of the average export turnover, whichever is lower, it is an exemption for them. So remember, the gems and the jewelry exporters, they have either 1 crore rupee or 2% of the average, whichever is lower, it is exempted. Then coming to pharmaceutical companies, means these companies which are manufacturing the medicines and they're exporting. And for them, the percentage for waiver is 8% of the average annual export realization. So if the previous year, previous 3 years, the average is 100 crores, they can up to 8 crore. Value of 8 crore export, they need not declare. So the percentage, please keep in mind, because once they have asked the percentage, what is the percentage for exemption or waiver of the declaration form. And then Reserve Bank of India can permit the specific permission. Declaration form is not required for this exporter. That the Customs Authority will be doing it. So if RBI permits on application made, that also it is waived. Set of export receivables and import payables. See, sometimes the merchant will be doing both export and import. For example, let us assume there is a person who is engaged in, or an entity, say for example Reliance Industries. They are doing export business and they are doing import also. So during a particular period, they have made an export of, say, 100 million Indian rupee. They have made an import of, say, 40 million Indian rupee. So this means this much they are receivable, they are eligible to get in the form of foreign exchange. And in the case of import, they have to make the payment. So these two can be set off. There are certain guidelines. Based on the guidelines, the set off can be done. What is meant by set off? In bank, as a banker, we are familiar with set off. Let us assume there is a person, he has got a deposit. He has a deposit of 2 lakh and he has a loan of, say, 50,000. And if the loan is becoming bad, means overdue, it becomes NPA. If the deposit and loan are in the same name, bank has got a right of set-off. What the bank can do is, from the deposit, they can take 50,000 and close the loan. And at one point, the rest of the amount can be kept as deposit or it can be given to the customer. So that is called the set, adjusting the receivables and payables. This is possible in the case of an exporter also. So there are certain guidelines. This set-off is eligible for exporters. Exporters are eligible for this set-off. Set-off means the export receivables, when they do the export, the amount they are eligible to get, and when they do import, they have to make the payment. So this too can be adjusted. The exporters are eligible. But what are the conditions? The first one, both the export and the import should have taken during the same calendar year and through the same bank. This is number one. So calendar year means 1st January 2024 to 31st December 2024, or 1st January 2025 to 31st December 2025. So during this calendar year, both the export and import should have taken place. It is number one. So if an export has taken place in the month of December and the import in the month of January, these are 2 different calendar years, you cannot set off. Number 2, this should be routed through, both the export and import transactions should have been routed through the same AD bank. Most of the customers, they may have account with 2 banks. The export they have done with the State Bank of India, and import they have done with the Bank of Baroda. then they cannot go for set-off. It should be through the same bank and during the same calendar year. Then set of export receivables against goods shall not be allowed against import payable of services. That means the goods and services. Export they have done export of goods. Import they have made services import. This both cannot be adjusted. So export of service can be adjusted with import of services, and export of goods can be adjusted with import of goods. The payment towards export of goods and import of goods can be adjusted. Export of services payment and import of services payment also can be adjusted. The vice versa, it is not permitted. Then overseas buyer and supplier should be the same, and consent should be obtained from the parties for making this set-off. Buyer and seller should be the same, and they should both agree for that for making the set-off. And AD bank should obtain a document evidence for both export and import. So as a banker, when both the transaction export and import are undertaken through that particular bank should call for the documentary evidence that actual export and import has taken place. And EDF will be released only after adjustment of the entire export receivables. So when a person is making an export, at the time of making that shipment, he is giving a declaration form. And the declaration form is called the export declaration form. This will be kept with the bank. And this can be released back to the customer only after ensuring that the money has come in the form of foreign exchange. So that is there. Therefore, the exporter should produce documentary evidence for both export and import. Then only you can release the EDF. Next is netting of export receivables and import payables. So the set-off and netting off are two different things. Don't get it confused. The set-off can be done by the exporter. There are certain conditions. Now coming to net-off. This is all the exporters, they cannot do this netting off. Netting off is done in the balance sheet of that company, that firm. So here, this netting off is permitted only for exporters located in special economic zone. So remember, netting off can be availed only by those units which are located in the special economic zone. They get some benefits. So those units are alone, allowed for both goods and services. Netting off, it is allowed for both goods and services of export and import. Indian entity and overseas buyer supplier should be the same. That is there for a set-off also. Netting off will be done as on the date of the balance sheet. Generally, the companies in India, the firms in India, they publish the balance sheet as of 31st of March every year. So as of the date of the balance sheet, 31st of March, say 31st March 2025, they can do the netting off. How much is receivables, how much is payable, they can have the net off in the balance sheet. This is applicable only for the units located in SEZ zone. EDF will be released only after adjustment of the entire proceeds. AD bank should satisfy with the documentary evidence of export and import trade. So these are all the points.